You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, the last couple of weeks, we were doing trades on the airlines. We're coming into a short week this week. We are taping Options Playbook Radio. It's Wednesday, July 1st. Welcome to July. And at the end of this week, Friday, the markets will be closed. And over the holidays, I'm going to focus a little bit on a trade that I like to do over the holidays, especially during volatile times like we have right now. I'm going to look at positions that you may have in your account that you may want to sell covered calls on as you go out on your pontoon to watch the fireworks or go hiking up a mountain over the 4th of July weekend. Whatever you want to do and however you want to celebrate is up to you, but selling some premium in times like this is an interesting trade, especially on positions that you own that you might not mind selling a little bit higher than where it's currently trading. Okay, so that's going to be the theme for today, but I want to talk about the two trades that I've done in the two previous weeks here on Options Playbook Radio. Now, as always, nothing's meant to be a recommendation. We're just trying to learn here on Options Playbook Radio, but we did a rinse and repeat strategy as far as United Airlines was concerned. And one of the big things about United Airlines and all of the airline stocks, or basically the travel industry, everything that applied to it, we're looking at extreme high implied volatilities. Now, we haven't even got into earnings, and I mentioned on both the last 2 weeks, I mentioned that I don't even want to be in these stocks going into earnings because volatility is so high already that I don't know why I would want to mess with earnings in general. So a couple of trades where I talked about trying to generate a credit into your account without all the risk that's involved, quote unquote risk that's involved, with doing a short call spread or a short put spread. Last week's show, we talked about UAL, and the option contracts that we were looking at had an implied volatility over 100%. So 100% implied volatility. UAL is a $34 stock. Meaning to say there was a lot of juice in those option contracts overall. And one thing that's been interesting about the airlines is that the last few months, not necessarily the last couple of weeks, but the last month or so in general, the historical vol has actually been higher than the implied volatility. But looking for implied volatilities to come in a little bit before we go into earnings. The trades that we looked at doing was we looked at a skip strike butterfly on UAL 2 weeks ago, and then we talked about a ratio butterfly. But the whole goal here was if you were thinking about doing short spreads in the airlines, and a short spread in general means you're selling an out of the money option contract, no matter if you're on the bull side or on the bear side, and then you're going further out of the money and buying some protection. So it is a high risk, small reward, but also usually a high probability trade overall. Now, the reason why I brought it up in general is I don't think I like those type of trades in this setting because of the things that I mentioned. One that we really focused on is that the actual volatility or the historical volatility has been higher than the implied. So the option market makers have got it wrong overall, right? I don't know wrong I have in question marks because there's no 100% right implied volatility overall. You can only all you have is hindsight to see what actually happened. But the actual volatility was more than what the marketplace was implying. So how would I adjust this trade? If I wanted to do a credit spread, I wanted to find a way to bring a net credit into my account, but I wanted to also hedge myself, the natural trade to do would be a skip strike butterfly. And we did one of those 2 weeks ago. We did it on the call side. And in general, I'd rather be on the call side. I have no idea where these stocks are going. I'm just flip a coin, not necessarily saying that. But I do know that if markets go up, implied volatilities have a tendency to go down, And if markets go down, implied volatilities have a tendency to go up. So I'm going to do the upside, because if I'm correct on my forecast, I want implied volatilities to come in. So that's the whole reason why I looked at two different butterflies, both of them with calls, both of them out of the money, both of them with a bullish trend to them. Okay, so in respect to the time of this podcast, I'm just going to talk about last week's trade. So a week ago, the markets were closed. It was June 25th. We looked at United Airlines. The stock was trading at 33.09 on the close. It was basically flat on the day. First flat day that's probably had in quite a while. And we looked at the July 10th expiration. So there's still some life left in this trade. Right now, as I mentioned, the markets are closed and the date is July 1st. United Airlines on June 25th was trading at 33.09. We looked at buying one of the July 10th 39 calls, selling three of the July 10th 41 calls, and buying two of the July 10th 43 calls. Now, the market was closed, but the midpoint was a net credit of, I think we said 10 cents. My screenshot from that trade from last week says 11 cents. We'll call it 10 cents. Now, the week before, we were able to bring in a little bit bigger credit overall, and those option contracts all expired worthless, and we made that net credit. But there's something going on this week. Guess what? The stock has actually slowed down, and it started to creep forward a little bit. So if we look at the chart, we actually had a run up all the way from 33 up to about 38. And now today on July 1st, the markets were open, I took a snapshot of the trade. And I see that according to my snapshot, that was a live trade right around the noon hour Eastern time. The stock was trading at 35.56. It was up 95 cents. It had ran up a little bit higher previously, but overall, that same trade was trading at even on the midpoint. In other words, we sold this for a net credit of a dime. We could close this out at even, meaning that we would make that dime. And the reason why I bring this up is that it's an interesting trade. We did have the market go up to the 38 level. And at that point in time, when that happened, this trade was actually not doing well. In other words, it was losing money when we had that quicker run up. Why? Because we needed time decay to work for us, and enough time decay or implied volatility had not came out of the option contracts. But right now, we're in a fairly decent place in that we have until July 10th before these option contracts expire. The stock is trading around 35. We're up a little bit on the trade, but I would say we want to stay the course because every day that goes away and we get a little bit more time decay, we'd also like that underlying stock to start going up towards our short strike. And the ideal situation would be on the last few days of trading in these option contracts that the stock was somewhere between the 39 strike that we bought and the 41 strike that we sold. We'd like to be somewhere in that range. You could even creep a little bit above the 41 strike and we'd still be okay. Where are we going to get a little nervous about this? If we go to 42, 43, 44 and beyond, well, then we could have our maximum loss of this trade. So our maximum upside would be that we could sell this for $2 and close out the position. So we put it on for a net credit of 10 cents and sold it for a net credit of $2. And our max loss in this situation is that if the market continues on up, we could lose that $2 because we sold an extra spread on this trade, and we'd have that max loss minus that net credit received in the account. So why is this an alternative to doing a short spread? Well, because it's a little bit schizophrenic here in that we're doing a trade, we're bringing in a credit, and we can't bring in, we're not bringing in quite as much of a credit as if we just sold a short call spread outright. But in this instance, I'm willing to stick around. The stock's at 35.56 right now. And if I was in the short spread, I would be a lot more nervous than if I was in this ratio butterfly spread. And so the moral to the story, which it always is with Options Playbook Radio, is that we're just trying to learn here. We're trying to see what an alternative, this strategy is this, and here's an alternative to that strategy. Or if we do this strategy, how can, what's a trade that we could plan on hedging with using the Options Playbook to try to come up with those answers. So in this marketplace, the moral to the story is I'd rather receive a little bit less credit, but I already have my hedge built in. Now, if this trade goes against me, I'm just going to close it out. That was always the plan from the start. Why? Because I already put the hedge in there. I put the hedge on that trade, but I want to pay a lot of attention to the timing of the move to the upside. And if I can really legitimately get lucky and the stock closes somewhere between that first strike, 39, and that second strike that we sold, 41, well, then this is a win-win. We did it for a net credit when we initiated the trade, and we'd be able to close it out for a net credit when we get out of the trade. Okay, so interesting. It was a great learning experience, a great paper trade, and it's still living, so keep following it. All right, so it's a shortened week, and I have a strategy that I don't get to talk about too much because, honestly, if I talked about this strategy every single time on Options Playbook Radio, I think you would get bored and stop listening. But it's a strategy that deserves some attention, and it's just covered call writing. Now, covered call writing wasn't the right thing to do at the March lows when everybody was down on their positions overall. If they stayed the course and waited for that dead cat bounce, guess what? They got it. It came the S&P 500 index came roaring back about 50% of its losses within about 3 weeks' time. The NASDAQ is now setting all new highs. But once again, we still don't have an answer to the coronavirus, and we still have high implied volatilities. So now is a more interesting time, in my mind, to use the strategy. It's called a covered call. I'm going to talk about Apple because I know most people know who the company Apple is and may have some of this in their portfolio. But the concept here would be that if I have stocks that have already came back or that are doing well, that are outperforming, because there's been winners and losers in this whole pandemic, without a doubt. There's some real big winners and there's been some real big losers overall. But a stock like Apple has done well. It's actually setting all-time highs. Most recently, it's already reached those levels. And you might have other different stocks. Walmart could be one of those stocks. Some ETFs that you've been trading. Maybe you've had some ETFs that are based on the NASDAQ, or even you could even look at some of the financials, because if you bought those right, you did okay too. So I'm saying that in general, if I have some profits, we're going into a holiday weekend. We have some high implied volatilities. We don't have earnings anytime in the near future on most of these companies, because I do want to avoid those earnings overall because we don't need them. Implied volatilities are so high. So think about the covered call strategy. You're going to be out on the lake, on the pontoon, out hiking, visiting relatives, eating brats and burgers, whatever you're doing, a way to generate some income on a holiday week. I always like to think about it going into it is think about doing a covered call on a position. So with that said, I'm just going to do a simple paper trade this week. Apple right now, as I mentioned, the markets are closed. It's July 1st. So this Friday is going to be the market holiday. And then I'm looking at the July 17th expiration. But in Apple, I don't even necessarily have to go out that far. There is a July 10th, but I'm going to look at the July 17th. And I'm going to go out. So that's 16 days away. And we're going to go pretty far out of the money because I don't necessarily want to get called away. If I owned 100 shares of Apple, I don't necessarily want to get called away. So I want to give myself some room. So I'm going to sacrifice some of the premium. I'm not going to bring in quite as much premium to go a little bit further out of the money. But the implied volatilities are still extremely high. I mean, we're looking at a 30% implied volatility over a holiday weekend on a $364 stock. Well, I can go all the way up to the 390 strike and still receive $1.20 at the midpoint for that strike. So that's giving myself all the way from 364 up to 390. I have 16 days remaining, and I'm just going to bring in some cash into my account saying that if it did get up to that level, well, I'm okay with either giving up my stock or I might roll my option contract out a little bit in time overall. So the moral to the story here is that this is a covered call, but we're looking at positions that have got a little frothy, that have had a big run up, that I might not mind selling if it goes a little bit higher, or I might actually try to generate some income on my account on that position, or I might end up rolling that position or doing something else. But the premiums are just so great across the board in quite a few of these underlyings because implied volatilities just are still staying pretty high. Now, prior to the big downturn in the markets, you'd usually see Apple trade around 20% or 15% implied volatility. A lot of times it trades right along with where the VIX is at, just in general. Apple kind of follows the market overall. And there may be some other stocks where you have a little bit higher implied volatility. But the 390 strike call, if I sold that, I could bring in approximately $1.20. If I sold the 380 strike call, I can bring in approximately $2.75. That means $275 for every 100 shares, and I sold one call against that position. But I think every once in a while people kind of forget about covered calls. And overall, I would not have wanted to do this at market bottoms. Why? Because you're pegging yourself. You're pegging yourself by selling a call saying that if this market does come roaring back, I have an obligation to sell my stock at that strike price. I don't mind it as much now that the markets have become a little bit frothy. We still got a lot of news out there that's a little bit scary overall. So this is in my mind, a much more interesting time to think about covered calls than it was when we were at the March lows. All right. Well, that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at TheOptionsGuy@invest.li.com. Thanks for listening. We'll be back at the same time, same place next week. Enjoy your holiday weekend. And until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.